Welcome to the Invest Like a Boss podcast.
I'm Sam Marks.
And I'm Johnny FD. We're self-made entrepreneurs who invest our own money and use modern technology to invest like a boss.
Join us each week for exclusive interviews with our network of modern investors, business owners, and multimillionaires to discover new ways to invest our hard-earned cash.
Hey everyone, welcome to episode 15 of Invest Like a Boss. This is Johnny FD with Sam Marks. How you doing, buddy?
Doing great, buddy. How are you?
Doing fantastic. I'm so excited. This is my last week here in Warsaw, Poland, and exactly 1 week from today, me and Sam are going to be meeting up in Sofia, Bulgaria.
I never thought we would ever say that or do that, but it just so happened to work out, and we're going to go overland to Kiev, Ukraine, 4-country tour. Don't even know how we're going to get there, but we're going to make it happen. We're going to have a lot of fun doing it.
But the best thing about it is it's still summer in Europe, and I firmly believe it's one of the most beautiful places in the world you can spend an entire summer. And I think everyone should make that a goal to just spend, either this year or next summer, wherever you want in Europe, but just do it.
Yeah, do it and make it happen through passive income. Finance it through passive income. Some of the things that Johnny and I have been working on. Johnny is doing a lot better than me, but I'm going to get there, buddy. I'm going to get there.
Well, you know what? You got the investment capital, so this is almost like a race, and I think that's why a lot of people like the show is you have one guy that has a big windfall, has a lot of money in the bank to invest with. You have another guy that doesn't have nearly as much, but I'm like, hustling every day, trying to catch up. So,
but you're Johnny FD.
Oh, and you're Mr. Sam Marks. So, today we talked to Meb Faber from mebfaber.com, and he is the co-founder of Cambria Investment Management. Super smart guy that writes a ton of white papers and different research on all the different, investment strategies and portfolios out there. Super smart guy. What you think, Sam?
Yeah, so this was a really fun episode. Oh my gosh. This is something when we first started the podcast, almost a half year ago, well, not that far back, but geez, we started talking about it. One of the things that got me interested in investing was Money Master the Game by Tony Robbins. We've talked about the book before. There's a lot of different opinions out there on it, and we'll say this in the episode as well. One of the things that I loved about it is it retrained the way I thought about money and investing, similar to the way Rich Dad Poor Dad originally piqued my interest in building wealth and thinking differently. So I always wanted to look deeper into the all seasons portfolio, which is kind of the benchmark and I would say the central focus of the book Money Master the Game by Tony Robbins. I don't think there's anyone out there that's more qualified to talk about it than Meb, because he has compared the All Seasons portfolio by Tony Robbins next to 10 of the other most highly touted asset allocation models over the last 50 years and seeing how they've all performed. So when I came upon Meb's content and his business and all the research he's done, it was like a gold mine. I just spent the next 2 weeks just knee deep in this stuff, staying up all night researching it. It's exactly the type of stuff that I've always been interested in, and getting him on the show was awesome, and it's one of my favorite episodes for sure so far.
The funny thing about reading Tony Robbins' book is because he kept dangling that carrot of that perfect portfolio, one that he kind of describes it as one that has historically always gone up, even in times of recession. So it's super safe, but it's always gaining money, and he kind of just dangles at the whole book. And to be honest, that kind of actually ruined a lot of the book for me, because I kept just trying to get through the book to get to that point. And so if you guys haven't read the book yet, don't worry about, big spoiler alert. If anything, I would just look at the show notes of this episode 15. You could see a screenshot of what is actually in the portfolio. And if you listen to this episode, you can hear why it's a good portfolio, but it doesn't mean that it's the best.
And that's very well said.
Exactly.
Go ahead.
And one of the big reasons why a lot of people, there's a lot of pros and cons for Tony Robbins' book, that some people love it and some people, are very against it, is because he really pushes a company called Stronghold Financial, which he may or may not have a vested interest in. And the all-season portfolio, supposedly only, goes through him, which isn't necessarily true, because it's just a mix of assets. But the reason why Sam and I like the book so much is because if you just ignore that small part of it, all the other information in there, all the interviews with, big name investors like Warren Buffett, all the hard questions that they ask him, things like, what set of instructions would you give your children to do with, to invest your money if you are no longer around. These are things that are highly valuable. So just ignore the all seasons portfolio, ignore Stronghold Financial as a recommendation, and we'll get into why in this episode.
Yeah, totally agree with that. I think there's a lot of value in the book in getting you to think about global allocations instead of potentially just investing straight in one asset class, say US stocks, i.e. the S&P 500. But one of the favorite things that Meb said during the episode was, go enjoy the summer. And that's a famous quote in his blog that he mentions a couple of times. And what it means is that people obsess about detailing their portfolio and getting just the right allocation and just the right rebalancing. And over the course of, say, 50 years, which would be a buy and hold strategy, and even over the course of 20 years, these portfolios, even on opposite ends of the spectrums, very heavy in stocks, very heavy in bonds, etc., they perform within a very tight range. So his quote is, go enjoy the summer, basically pick, buy and hold, go enjoy the summer, don't obsess about it. And one other famous thing that will always stick with me is in this episode, he mentions that Fidelity did a big detailed report of all the different accounts that were through them, and they found out
that in this episode he's going to tell you which one, but as food for thought, you guys can start thinking about this right now. Mm-hmm. Out of these three categories of investors, I want you guys to kind of guess who did better with the returns.
I like that.
Okay. Expert investors. Actually, there's four categories: expert investors, novice investors, people who have completely forgot they have a Fidelity account, or people who have died. So keep that in mind. Pick your answer in your head. And through this episode, not only is Meb going to explain, expose which one of those did the best, but also why.
Trivia of the day. Everyone get your hats on.
I like it. And as a bonus, I'm going to give you guys a stock tip of the day. I'm only bringing this up because I just woke up seeing that Facebook stock just skyrocketed. And it's because their quarterly earnings report had come out recently. And it's, I guess they did extremely well. Facebook's a hugely growing company. So their current stock price is up to $125 right now, which is a record high. So my stock tip is, even though I got really, really lucky buying Facebook stock, do not buy individual stocks. You're just completely gambling. But if you insist on trying to figure out, why things, do the things they do, or why I bought this in the first place, it was because I think it was exactly 2 years ago, one of my buddies, JP, he's a multimillionaire in the casino market, which, hopefully I can get him on the show one of these days. He basically, was saying to me, I don't understand, Facebook's quarterly earnings came out, and on paper they did great. They made a lot of money, but the stock price is not reflecting it. For whatever reason, the market or the people are not confident in Facebook, even though their quarterly earnings are showing. And his idea, and this is just a hunch, right? This is still a gamble. He said, you know what? I think I'm going to buy a bunch of Facebook stock because, I like companies that do well financially. And for whatever reason, if public opinion doesn't reflect that, hopefully they will soon. So he convinced me to buy he didn't. He actually specifically said, Johnny, I'm buying it. This doesn't necessarily mean you should buy it. But I took that and ran. And I figured, if he was going to buy $1 million worth of Facebook, I could put in a couple $1,000s, and I did. And the lowest I got in was at $55 a share, and now it's at $125.
And you sold too early, my friend.
No, I still have it.
Oh, okay, great. Well, we both own it together. So
nice, buddy.
Cheers to Facebook. We'll keep using it and clicking on ads so the revenues can go up, and we'll just continue to reap the benefits. But actually, in this episode, Meb also talks about how, and supports it through a lot of research about how hard it is to pick stocks and why you're better to diversify. But without spoiling the rest of the episode, we'll let Meb share his knowledge and wisdom and educate everybody else, including ourselves. And I'm definitely going to listen to this episode multiple times. Yeah,
100%. Even though it is possible to get lucky with individual stocks, I don't own any other stocks right now. This Facebook is the only one I own. I'm never going to buy another individual stock again, probably. And all I do is pretty much what Meb says. So listen to this episode and enjoy.
Welcome back, everybody, to another episode of Invest Like a Boss. Today, I'm joined with the man, Mebane Faber, who is the Chief Investment Officer of Cambria Investment Management and the author of 5 books. We're very glad to have him on. Mebane, thanks a lot for joining us on the show today.
Hey, great to be here.
So you're over in Manhattan Beach. I'm in Singapore. We had on Brett Crosby, who is the CEO of Pier Street, and he's also in Manhattan Beach. So we got almost 2 back-to-back in Manhattan Beach, and it's one of
I know those guys. I just had beers with them a few weeks ago. Good guys. I'll have to listen to the podcast after we finish.
So it was the exact same timing. It was 8 o'clock in the morning my time, 5 o'clock their time, and Brett was headed out to the Manhattan Beach Pier for a beer afterwards. So hopefully we won't keep you too long, but I really, really love the content that you publish. It's fun. It's easy to follow, high energy, highly explorative. So all the things that we love here. I wish the investment world had a lot more people like you. And I know a lot of our listeners already listen to you and follow your podcast. They follow a lot of the content, which is actually how Johnny and I got introduced to your blog and everything else that you guys do. For the people that are not familiar with you and the stuff that you publish, can you give us a little background on how you got into the financial world, being a skier and a surfer that you are?
Sure. I mean, my background was in biotech and engineering, and I actually started out, taking a year or 2 off before grad school to work in the investment space as a biotech analyst. And then that 1 or 2 years became 3 or 4. Did some grad school, but eventually gravitated more and more towards the quant side of the business and more away from the biotech side of the business. And some of those very little forks in the road you take when you're young. I ended up on the West Coast in San Francisco, and then Tahoe, and then down to Los Angeles, and started up Cambria, my company, in 2006 with my co-founder, and started managing money then, and kind of never looked back. So kind of a windy road, but ended up a lot of it. The writing and publishing side was a little bit by accident, but has become what originally was what's the right word? Painful exercise has become somewhat of a fun, enjoyable daily ritual of putting out content. So now we do a lot on the both academic side, whether it's white papers and books, but also kind of a bit of content for the broad audience as well on the blog and podcast too.
Man, so I saw a number that said you had published 1,000 blogs in 5 years.
I think it's 1,500 over that.
God, so that's every day you're writing something, right?
I think more. It says that I started writing in like 2007. So more, it's just, I went back the other day and went and read every blog post I published, and I tweeted this, and I said, because half the links are broken now, because I would link to companies or people's websites or other bloggers, and I'll paraphrase, I can't remember exactly what I said, but it was something like, in life, it's such a compliment just to survive. So not just in your profession, but whether you set out to be a writer or a podcaster, you guys have a certain amount of podcasts in the bank already, but, fast forward 2, 3, 4 years and people don't realize, how much work that is. So it's amazing to look back and see just, how much creative destruction there's been. And we said it's just keeping your head above water is tough to do.
Yeah, absolutely. So what does that look like for you? Is it a daily ritual of writing when you get up or something like that?
It's morphed over time. So in the beginning, I started writing academic papers, and then that transitioned a little bit into the blog. Then the blog transitioned into a little more long-form books, and that transitioned from traditional publishing to self-publishing, and then more and more content came out on Twitter. And then we have a research service called the Idea Farm, which caters more towards the kind of academic professional investors. And then now, what mentioned, started the podcast. And so I have about a dozen episodes in the tank, and it's all kind of the same. 30 years ago, people were doing radio shows and writing editorials. It's just the internet has enabled us to have a much bigger soapbox for better or worse on getting your message and thoughts out there, and it enables you to talk crystal clarity with somebody in Singapore to LA nowadays.
Yeah, it's pretty incredible. So we have a Facebook group called the Boss Lounge, where we kind of have a lot of our listeners in there, and we're just talking about pretty much new ways to invest and trying to figure out fun ways to learn about investing, because so much of the stuff that you buy in a book from the 90s is completely outdated. And one of the things that turned, I guess, so Johnny and I are both, I would say, well, we're both entrepreneurs, or we've both made money previously through businesses, and we come into the position of trying to learn how to invest, where traditionally all of the, our parents, everyone, they would either buy a piece of property or they give the money to a broker. And there wasn't that many options, or a couple of bank products. So we're trying to explore all the new modern ways of investing and get educated in the modern world of investing versus books that were written back in the 90s or something. And one of the books that kind of piqued our interest was the Tony Robbins book, Money Master the Game. And there's a lot of different opinions out there about the book, but I think similar to one of our favorite books, which was Rich Dad Poor Dad, it just kind of retrained you to think differently about money, or about the way that you were taught to do something. And I guess the kind of main point of that book was, or the main focus of that book was, ended up being the All Seasons portfolio. And so I think you are probably the best person in the world to talk about this, from all the modeling you've done of different portfolios over time. And so I wanted to focus a little bit of the conversation around that model and some of the other models that you've also compared it to see what might be a good model for us to consider for the future.
Sure. So there's a lot in that kind of statement and question. And, part about looking back at books historically, there's some timeless pieces of investment wisdom in books that, are universal. And then there's others that are much more kind of representative of technology in the times and different ways to access asset classes. But if you take a step back, and one of the biggest challenges for an investor, particularly younger investors or people who are not looking at spending a lot of time with investing, is you really need a lot of respect for history and understanding markets. So there's a lot of surveys in the last year or two that'll ask young investors, what do you expect in the stock market? And they'll say something like 12% a year. Well, that's because we've been in this 8-year bull market, and they haven't lived through a global financial crisis like an '08 or a tech bubble like 2000, but each different type of market rhymes somewhat differently. But being able to look back to 1900 and say, hey, look, I understand that this is the U.S. experience, but also these other countries went through hyperinflations, or there's countries like China and Russia that shut down their capital markets altogether. Or there's a market like Japan, which is the second biggest economy in the world, now third, but at the time was the largest stock market in the world in the 80s, that had zero returns for 2 decades. And that's not some like backwater tiny country. That's one of the biggest countries in the world as far as economies. And so trying to understand what's possible in a base case scenario. And so being able to have an appreciation for history. So one, there's a great coffee table book called Triumph of the Optimists, and it's expensive. It's like $100, but you can download. Credit Suisse does yearly updates called the Global Investment Returns Yearbook. And if you Google that with Credit Suisse, Geary, Giry, there's about 10 years worth of downloads that are absolutely must reads, fantastic reads. The introductions can be a little academic, but you can flip through this book. It's beautiful, well done, and get a perspective for at least what's possible, at least understand, hey, this is what I can expect in markets, or, because it starts to give you the BS detector of being able to look to a lot of investments and say, hey, that's not even possible at all. I understand that that's not even reasonable. So we did a book that part of it talks about this Tony Robbins portfolio, but we took a step back and said, look, there's a lot of gurus out there. So Tony Robbins, but also Ray Dalio, who runs the largest hedge fund in the world, David Swenson, who runs the Yale Endowment, Rob Arnott, research affiliates, $180 billion money manager, Mohammed El-Arian, who used to run Harvard and PIMCO, that have all at some point made a recommendation for individuals for an asset allocation portfolio. And so we wanted to do a thought experiment and said, okay, why don't we go look at these dozen or so models and examine how they've done historically and see what we can kind of glean from that. So we wrote a book called Global Asset Allocation. And actually, for your listeners, if they want a free copy, they can go to, we have a website, freebook.mebfaber.com. You can download it.
I bought it on Amazon, and then I saw the free link afterwards.
Hey man, it's only $3 on Amazon. So either way, I'll buy you a beer next time you're in LA for the $2 I get from that.
Cheers, bro.
So anyway, download it. But it's a fun book because we look at all these portfolios that are vastly different. So some of them, for example, say put 25% of your portfolio in gold. and others will say nothing. Buffett famously says, put 90% of your portfolio in U.S. stocks and the other 10% in cash. So there's these very different portfolios. And so we tested them back to the 70s. And one of the biggest stunning takeaways was that over the course of the entire period, so that's 40 years, there was a very, very tight coupling of the returns. So top to bottom, best to worst performing portfolio, if you exclude the permanent portfolio, because that one it was developed decades ago, but it's a 25% each in stocks, bonds, gold, and real estate, I think. It's a little more low volatile because half the portfolio is in cash and bonds. So if you exclude that one, all the rest of the portfolios, despite how different they were, clustered within 1 percentage point difference in returns. And that's a really stunning conclusion. Now, they took different routes to get there. So the inflationary 70s, portfolios that had commodities and gold did much better. In the disinflationary growth 80s and 90s, bull market, what did best? Of course, it was stocks, growth type of assets. But we did another experiment, said, okay, take a step back. Crystal ball, you can go back to the 70s. I'll let you pick the best performing asset allocation of these dozen managers. Yep. Turns out it was Muhammad El-Arian portfolio, what we call an endowment style portfolio. So that means a lot in stocks, a lot in global assets, a lot in growth assets, and very little in bonds. And so it's no surprise that that portfolio performed the best over that period. If you then compare that to the worst performing portfolio, permanent portfolio, and say, all right, I'm going to go back to 1972, implement this portfolio with the average cost of a mutual fund today, which is 1.25%. Certainly you can get Vanguard index funds for much cheaper, but that's the average cost of a mutual fund. That takes the performance of the best asset allocation portfolio and makes it almost as bad as the worst.
Wow.
And this is a really interesting takeaway because what do most people focus on? They focus on the numerator, the returns. They focus on how much money can I make. Then they may focus on volatility and drawdowns, and all those things are important. But it's really kind of the boring stuff for asset allocation. It's the boring stuff that lets people, the fees, the taxes, the transaction costs that really can determine a lot more of your success than the actual allocation itself. And so if you then go and say, you know what, I don't want to deal with this. I'm going to implement this through my financial advisor. Average cost of financial advisor is 1%. So now you're up to 2.25% per year. It takes the performance of the El-Arian portfolio and makes it far worse than the worst performer, which is the permanent portfolio. So what we say with that buy and hold asset allocation, if you're going to do that, it doesn't matter that much what the exact allocation is. As long as you have some global stocks, some global bonds, and some global real assets, which is commodities, gold, tips, or real estate, then it really doesn't matter. But what does matter is implementing that in a very cost-effective manner. So whether it's through low-cost ETFs, low-cost mutual funds, whatever it may be very thoughtful about all-in costs as well as taxes and transaction costs too.
Awesome information. And I wanted to jump back to one thing that I thought you said it was particularly interesting, going back to speaking about the Japanese market. I had read a book a long time ago, one of the first books I read, I guess, about investing, but also demographics. It was called The Demographic Cliff by Harry Dent. And it brought up the point about the Japanese market going back into whatever it was, late 80s or 90s, where it was just flat for 2 decades, right? And so that kind of, as an early investor, people always say, just, Warren Buffett's like, put money in the S&P 500 and forget about it. I mean, there is the possibility that because of demographics or other reasons, like if you put money in just a stock fund that was domestically, I guess the S&P is much more international, but because the US companies have international revenue streams coming in, that if you were to put money, say, in the US domestic market, there's no guarantee that in 20 years it's going to be higher than it is today, correct?
So here's a couple examples, just food for thought. So if you look at periods where US stocks have underperformed bonds, there's many periods of 20 to 40 years where stocks don't outperform bonds. There's even a period of 68 years in the 19th century where stocks don't outperform bonds, but you start to get to a little more questionable data the farther back you go, but it's not a guarantee. And there's periods, so if you look at the 20s, US stocks went down over 80%. And there's basically not a foreign market in the world that hasn't had a decline of at least 2/3. And so the Japan example is interesting because we did another book called Global Value that looks at how to value global stock markets. And so Japan is an interesting example. So we use what is called a 10-year price to earnings ratio, what many people know as a Shiller-Cape ratio. It simply is a way of having a really long-term perspective on a security, or in Shiller's case, he talks about an entire stock market. It goes all the way back to Ben Graham talking about this almost 100 years ago, and he adjusted it for inflation. And so for the U.S. stock market, it's had a Cape ratio historically of around 17. It's been as low as 5, and it's been as high as 45 in the 1999 dot-com bubble. Currently at a value of around 25, which means it's expensive, but it's not terrible, and it's not a bubble. It just means future expected returns are going to be less. So you're looking at, let's call it 4%, maybe 5% returns in the U.S. stock market. Well, Japan in the late 80s hit a value of almost 100 with their price to earnings Shiller-Cape ratio, which is double what the U.S. was in the 99 bull market. It's the biggest bubble we've ever seen. It's not even close. And so the younger listeners aren't going to remember this, but there's a lot of coincident indicators when stuff like this is going on, when the world's going crazy. If you're in the late 90s, everyone's talking about dot-coms, and this is the world-changing technology, which it was, but people get too much greed in you start to see these market manias. Well, it happened in Japan in the 80s because Japan was transforming the way the world did business. There was automation. They were dominating electronics, automotive. And so the reason their stock market had 20 years of terrible returns, what they call the lost decades, demographics may have played a role, but the biggest headwind was the fact that they had the largest bubble we've ever seen. And so it took them 20 years to work off that bubble. For the U.S., it only took 9 years after the 99 bubble. And so the magnitude of the bubble often will show how long it takes for the market to correct. And so the way the world looks right now, the good and the bad news, the U.S. is one of the most expensive markets in the world, but the good news is the rest of the world is either reasonable or really cheap. So emerging market index in general, really cheap. It's at a Cape ratio of around, I think, 13 or 14. There's about a dozen countries that are in single-digit PE ratios. We did an article at the beginning of the year called something like Global Stock Valuations. It said the cheapest market in the world right now in January was Brazil and Russia. I think Brazil, I think, is up about 60% this year. Russia's up maybe 20 or 30. But it's simply those markets have been down so much, and the rest of the world hasn't recovered the same way the U.S. has from the global financial crisis. And historically, U.S. versus the rest of the world is a coin flip. So it's literally 50-50 outperformance any given year, whether it's U.S. or foreign. And there's been 2 periods since 1972 where foreign stocks have outperformed the U.S. stock market 6 years in a row. So not 6 years rolling, but 6 years straight. So we're much more bullish on foreign markets in general than the U.S. right now. I think there's a lot of opportunity in the cheap ones.
Good stuff. So a lot of my favorite blog posts of yours, which you actually recapped some of your favorite blog posts in a recent blog post, show a lot of these models that you guys have considered dating back over the course of 50 plus years. And comparing them in a really easy to follow way. I love those articles. And I also love the one that was, let me see what the title was, Risk Parity versus Endowment Model versus Permanent Portfolio. And in there you have 2 videos that kind of explain this stuff. It's you actually talking and reviewing everything, and there's nice graphs to complement it. So that's great. You use the word risk parity a lot. Can you explain? I've been trying to figure out how to summarize that in like a sentence or 2. Can you explain what that is for the listeners?
Sentence or 2 is tough. It means trying to equalize assets based on their volatility. So it would be like, at a horse race where if the jockey comes in underweight, they'll add weight to the horse to equalize the weight that the horses are carrying to make it a fair race. So what happens basically, the simple description, let's say you have a portfolio, traditional moderate portfolio, which is 60% stocks, 40% bonds, what we call the 60-40 portfolio. That portfolio, because stocks are so much more volatile than bonds, does not have 60% of the volatility and risk in stocks and 40% in bonds. It has about 90% in stocks. And so the way that you equalize that is you can either simply own more in bonds, so it would look more like, say, 70% in bonds and 30% in stocks, so that the volatility is similar. And then you can leverage that portfolio, which is a little easier to do if you're an institution or know what you're doing. It's a little harder as an individual. There's a lot of brokerages that charge criminal leverage rates, but there's ways, certainly easy ways to do it. Certain brokerages are reasonable, like Interactive Brokers. So you equalize things for volatility, and then all of a sudden then it comes down to expected returns and correlations. And so the holy grail of a risk parity strategy is adding a lot of assets that don't correlate. And so that's hard, of course, because there's things like stocks and bonds, which historically aren't correlated, but it bounces around. There's periods where they're very highly correlated, and there's periods where they're definitely highly uncorrelated. So it's a challenge, and that's what makes asset allocation fun, because there's regimes and periods where things look similar and don't. And that's why 2008 surprised so many people, is because we haven't seen a deflationary environment like that in a very long time, probably back to the 1930s in the US. And so risk parity, you're trying to find as many assets or strategies that you can equalize for a certain level of volatility or returns. And basically it allows you to customize it any way you want. That's the longest 2-second description I can think of, but it's basically trying to say, we're trying to make things, all things considered, make things equal.
So to make this easy for someone to digest, you guys created a risk parity model that's called the risk parity 160%.
It sounds right.
Yeah. And so that was, you compared that over some of the other models that you just talked about, the 60-40, the perfect portfolio. And over the last 40 years, it seemed like that outperformed and was less volatile than all the others. I'm trying to see what I wanted to bring up what the percentage breakdown was, but it was really heavy in bonds. I think it was like 70% in bonds.
Yeah, the simple takeaway for risk parity often is that the practical implementation is that you end up with more in bonds and less in everything else. And so part of the challenge there, of course, is that you've had this massive bull market in bonds starting in the early 80s that still continues today, with the U.S. sitting at, 1.5%, but half the world sitting at about 50 basis points, and even a number of countries, which I'm sure if you polled most of the economists in the world 5-10 years ago and said, what's the chances of a world where sovereign bonds are actually negative yield, they would have laughed at you. And so we have this world, we've had this massive bull market in bonds. And so one of the biggest challenges, of course, to a risk parity portfolio is, will that continue? And I think that's really hard to be able to count on that being a tailwind in the future.
Well, if bond rates go negative, then will bond prices continue to increase?
If they go more negative. So like if the U.S. went from 1.5% yield to 0.5% or 0 or minus 1%, yeah, those bond prices would go up until the point it gets to where it is, and then you're stuck with bonds yielding nothing. And so you've had this environment where there's been this search for yield for the past 15 years, and it creates a lot of distortions. For example, a lot of institutions, individuals are starting to reach for yield. So a lot of strategies like dividend stocks, which historically work because they trade at a valuation discount to the overall market, are, I think, hugely dangerous right now because they trade at a valuation premium to the overall market because so many people have rushed into them. Utilities are up something like 20% this year. A lot of low volatility strategies have been marketed, and basically, but things like farmland, for example, where people are just looking for anything that has a yield, it creates distortions, and it changes what we say flows change factors. So if you have enough money chasing an asset class and get to the point where that asset class is expensive and no longer attractive to the end investor.
Yeah. Would you class REITs as the same as that? As
REITs have had a monster run. And so if you look at valuation models for REITs, and it's a little more esoteric, but even just looking at the dividend yield, REITs are certainly not an attractive valuation. And we look at the world from two stands. One is valuation and one is trend and momentum. So REITs have had a wonderful momentum and trend. They've been going up. They have very strong performers. So that's a positive note. Valuation, though, the more they've gone up, the worse the valuation looks. So it's a mixed bag, but they certainly are not cheap.
Yeah. So as you said, a lot of people are concerned about rising rates with a bond allocation. And I look back at the risk parity model that you guys tested in the 70s, and it was about even. I mean, the allocation was 70% in bonds, I believe, but it actually outperformed most of the other models. I think there was 5 or 6 other models that you tested back in the 70s. And I think the real returns, or the nominal returns, were 8% of the risk parity, and the real returns were about even. But I would have thought that would have performed much worse than the other models in the inflationary 70s.
The 70s were brutal for almost every asset class. So depending on the model and what it included, for example, if the allocation included gold, which did wonderful in the 70s, then it helped balance it out. And a risk parity portfolio is basically says any asset that you think is a reasonable expected positive return over time, you can include in the portfolio. So depending on exactly what it had, it may have had good performance or not. I can't remember the exact allocation, but including things like commodities and gold certainly would have helped in the 70s, and are having a wonderful year this year. Many commodities as well as gold and silver.
Yeah.
And emerging markets are having strong returns in 2016.
The all seasons portfolio that was outlined by Tony Robbins, it seems to be almost a perfect take off of Ray Dalio's at, I think it was Bridgewater.
Yep.
Bridgewater, yeah. So I just want to review for the listeners that aren't familiar with that model. It's 40% long-term government bonds, 15% intermediate government bonds, which would be a total of 55% in bonds, 21% U.S. stocks, 9% foreign stocks, 7.5% gold, and 7.5% commodities. And it looks like that of the models that you guys tested, that model over the course of, say, 40 years underperformed four of the 9 portfolios. However, it's kind of like going back to what you said before. It's all those over the course of that much time operated in a pretty tight range. And I liked at the end of your post where you compared all these together. And the conclusion was, quote unquote, go enjoy your summer, which I just took as don't overthink it. As long as you have something in this range, and you're going to hold it long term, just don't obsess about it.
Most people are human, and being human means we're full of emotions, greed, fear, but probably even the biggest one, envy. And all we want to do is muck around with the portfolios. And Fidelity had a great study that looked at performance of their individual accounts and found that the best 2 performers were either accounts where people forgot they had an account or where people had died. And so it's a great example of just like laziness and sloth when it comes to asset allocation. The worst thing you can do is change your asset allocation based on what's working. So the 70s is a good example. If you invested in the 80s and 90s based on what worked best in the 70s, it would have destroyed your return. And so coming up with a policy portfolio or an allocation where you're comfortable with it and you basically stick to it, that's fine. And then Rob Arnott has a good phrase called over rebalancing, meaning when you just rebalancing every year or every 2 or 3 years, but making sure you rebalance to you're buying the things that are down and selling the things that are up. And it doesn't really, like I said, it doesn't really matter the exact allocation as long as you have the main elements, as long as you stick with it, because any asset class, you got to learn to be asset class agnostic, which is hard because everyone wants to cheer for a certain asset class. We tweeted out a study that talks about home country bias, and particularly every country in the world. So the U.S. only makes up half the world's stock market. So if you're an American investor, you should have at least half of your stocks in foreign stocks, but no one does. They hold around 70% in the U.S. This happens everywhere, though. It happens in Australia, UK. I'm sure it happens in Singapore. It certainly happens in Asia, broad Asia, where most people put most of their assets in their own country, and that's a horrible thing to do. And so as long as you have a balanced asset allocation that's global, and the global market portfolio, meaning if you just went out and bought the world, is a good starting point. And then it's not just mucking around with it too much. I mean, because most people, that the challenge they have is chasing returns and buying what's hot, and it can really decimate the returns of a portfolio.
Yeah, I agree totally. I've been burned. I mean, I started investing in like 2004 when I was in college, and almost everyone that I know who has been investing either in property or in the market that's in my age group has all lost money because you're investing while you're in college, and then you have the 2007, 2008 crash, and even before that, going back to 2001. So people have been getting in at the wrong times, getting out at the wrong times, and there's just been so much emotion and turbulence in the market that investing your first amount of money is, I think, a lot more difficult because there's too much emotions attached to it to foresee the future and be able to have the mindset to be able to handle 50% dips, right?
Yeah, and the challenge is that this shows up behaviorally in all of the statistics. So people chasing performance shows up in what's called dollar-weighted versus time-weighted returns, meaning time-weighted is simply the returns of a fund. Dollar-weighted is how much people put money in. So one of my favorite examples is a mutual fund. There was the mutual fund manager of the decade in the 2000s, Ken Huebner's CGM fund. And this fund did something like 14% a year, but the average investor in this fund not only didn't do 14%, didn't even have positive returns, had negative returns because he had a 70% year. Everyone said, this guy's a genius, gave him a ton of money. His fund goes up how many ever billions, and then he has a huge drawdown of 50% or 70%, whatever it was, and all the money comes out. And people do this over and over again. And most of the academic studies shows this often can cost people about 1% or 2% a year by chasing performance. And this is one of the benefits. I give advisors a lot of flack for charging a lot, but they can often be worth their weight in gold if they keep people from doing dumber stuff.
Yeah.
And the behavioral coaching of talking you off a ledge or just not wanting to chase these returns, because it's very seductive when your neighbors or friends are making a ton of money. Look, the last 7 years, if you're an advisor that had an allocation to foreign stocks or commodities, every year your portfolio review with a client would be, why do you own these? They just keep going down. And trying to educate these people and say, well, look, historically, this is what it's done. This is why we own it, et cetera, et cetera. And at some point, the U.S. will underperform many years in a row, and these will balance it out. It's very challenging because the investing timeline plays out over a totally different timeline than we think. We're thinking, particularly nowadays with Twitter and social media and the internet, in minutes and hours and days, and investing doesn't even take place in the course of the long wealth building in weeks or months or quarters. It's years and decades. And so the biggest challenge is by far for most people is overcoming their emotions.
Yeah, it's so true, and it's very scary that trading is too fast now. So someone like me who has too much time on their hands, I turn on the TV, there's a geopolitical event, and I'm 4 seconds away from my E-Trade Vanguard account to either buy or sell. And like you said, if it would just work out so much better, I know from my personal experience and my investing track record to have just never had access to be able to make those trades.
The good news is, though, especially for young people, is that it's really hard to impart that knowledge on someone who hasn't been through it. So trying to explain a bear market or what it feels like to lose 50 or 80% of your assets in your portfolio, or because when that often happens is also usually correlates to it being a bear market and poor recession in the economy, people losing their jobs, everything else happening at the same time. And trying to explain that to someone doesn't make a lot of sense, but the pain of losing money is very real and very physical. And so once people have been through it, once they make all the dumb mistakes, and look, I have all the behavioral biases. I'm overconfident. I'll take too much risk, and there's about 20 others I have, but that's why I'm a quant. So being able to say, look, these are the rules from which I operate. These are how I set up my portfolio. It keeps you from doing a lot of the dumb stuff. It doesn't mean it's still not seductive, but it's a much better framework for investing than just watching CNBC and shooting from the hip.
As we all do. So do you guys have all the different models that you've tested? It looked like the risk parity 160 was the best performer. There's obviously the concern of rising interest rates. Do you guys have a model, like if someone was going to ask you for asset allocation model for the next decade, do you have something that's kind of like a go-to, this is what we recommend, or is it always different?
I'm going to answer that in two parts.
Okay.
So the first part will be, if I was to design a portfolio, and we just put out a new paper called the Trinity Portfolio in the last week or two, it's free to download online, that says basically, if you had to ask me how to design an ideal portfolio, here's how I would do it. And there's three main steps. One is start with the global market portfolio. So if you were just to go out and buy the world, what would it look like? So you own stocks, foreign bonds, foreign bonds, real estate, foreign real estate, commodities, the whole caboose, right? So you start there, and that's a good allocation. And that's what we call, in the book, it's a global asset allocation or global market portfolio, not too far from the risk parity. So that's the start. And then you can improve upon some of the indexes. So we add tilts in the portfolios to value and momentum, meaning you're tilting your portfolio to cheap stocks and cheap investments. You're tilting it to cheaper bonds, but you're also tilting it to things that have good price momentum, which is historically one of the best academic anomalies. And the last one is overlaying a trend following component. We haven't really talked about today, but for me, if I had to pick a desert island strategy, that's it. And so that all in is what we call the Trinity Portfolio. So you end up with roughly half your portfolio in these buy and hold core strategies, another half in what we consider to be momentum and trend. That's an ideal portfolio. We're actually making a big announcement, depending on when this podcast goes live, for individual accounts coming up at some point in early August. So keep an eye out there. Stay tuned. But the second part of that question is, all right, Meb, gun to your head, if you had to pick an asset class or portfolio today for the next 5 or 10 years, what assets do you particularly like? And this is a little more subjective, but it's based on objective research, is I would certainly tilt away from the U.S. You've got to add foreign stocks are much cheaper. Emerging markets going into this year were down 3 years in a row. This is a study we put out in my first book, The Ivy Portfolio, where examining asset classes that have been down 3 years in a row. And this has only happened 4 times since 1972. It happened to long bonds in the late 70s, early 80s. It happened to U.S. foreign and emerging market stocks 2000, 2003. The future 2-year returns are about 50%. And so this just triggered at the end of 2015 for both emerging market stocks as well as commodities. So those are 2 asset classes that are down a lot that we think would be wonderful allocations in a portfolio if you don't have them, and if you do, with a possible overweight. So that and a trend following component, which is probably, you'll have to have me back on in 6 or 12 months to talk about. It's a whole episode in and of itself.
Right.
But managed futures and trend following is an area that is certainly philosophically aligned with what I believe in the world and diversifies a traditional portfolio more than almost anything.
Nice. There's an uneducated theory in our group that seems to think I think, and this also is a little bit because of where we are as small business guys, that all the growth in the markets over the next decade or so will be in small cap. How do you feel about that compared to investing in, say, like the S&P 500 or large cap?
Okay, so market cap weighting, which means the S&P 500 or mini indexes, which is the market, by the way. That's if everyone's to go out to buy stuff. It's a good first way to invest. But if you're an alien and you came down and said, let me pick the best investment strategy, that really doesn't make any sense, because all you're doing is you're weighting stocks by their price. It's not how big they are based on revenues or earnings or anything else. It's simply their price. The formula is price of the stock times shares outstanding. That's it. So it's a momentum strategy. So you own more of companies as they get bigger. And as companies go down or go out of bankrupt or go out of business, you own less and less of them. So it's a reasonable strategy. But the problem is market cap weighting has an inherent bias to owning more of expensive stocks. And so also the bigger a stock gets, so Apple, Google, IBM, Exxon, Walmart, all these huge companies, it's the property of capitalism that when you're that big and making that much money, you have a huge target on your back. And that's the beauty of creative destruction in our marketplace, is that when Apple's making these killer iPhones, other companies say, hey, we'd like to make billions of dollars too. So you have this destruction, and it has an effect on the stocks, because a market cap weighted index, you could weight an index basically any other methodology besides market cap. So equal weight, if the letters of the stock is A through M versus N through Z, it doesn't matter. That's going to be market cap weighting, because you break that price bond. So you could do valuation, which is much better. So inherently, there has been a smaller stock, what they call small capitalization tilt. Part of that is because you end up looking a little more like a value tilt and just doing anything to move away from a market cap weighted tilt. So you have a lot more potential with small stocks for value add. Most of these big stocks are covered by 50 analysts. Everyone owns them, etc. If you're toiling around in the small stock world, there's more value add, but it's also more dangerous. Many more of those will go out of business. There's a great study called the Capitalism Distribution, which I encourage you all to download from Longboard, which gives you some background on just how hard it is to pick stocks. But yes, in general,
as my E-Trade account indicates.
Exactly. So it's the numbers are stacked against you, unfortunately. So, but if you are looking for the big winners. Obviously, it's not going to be a company that's a $500 billion market cap already, like an Apple. It's going to be the company that's a 50 million market cap that can grow into a 500 million, 5 billion, that are going to be these 100 bagger type of stocks. The challenge is most of the characteristics for those stocks are usually not the characteristics you really want if you were to go out and screen for them. So it's tough.
Gotcha.
It's really hard game, but it doesn't mean it's not fun. It's not worth doing with a part of your portfolio. It just means it's hard to find.
Good stuff. So, Meb, I know we're coming up on time. This has been a lot of fun. I was hoping we could answer a couple listener questions quick before we break.
Let's do it.
All right. So one is from Steve M. He wanted to know what your thoughts are on robo-advisories like Wealthfront and Betterment and their value.
Okay, so there's two parts to this question to me, and we've done a lot of posts on this on the blog, including one post called "It's a Wonderful Time to Be an Investor." The offering to individuals is outstanding, and it gets better and better every day to be an individual investor. Commissions are going down. In many cases, they're free through an app like Robinhood, or certain brokerages have zero commissions like Wealthfront and Betterment. They were some of the pioneers in these digital advisories. A lot of what they offer has been around for 20 years. So the tax loss harvesting people have done for forever. What they've done is they've added a really pretty user interface. And what we've always said, and we love Betterment in particular, and we've sent a lot of clients there, but we've also said that it's going to be challenging because this will eventually get dominated by the custodians because they have their own funds. So like a Vanguard and Schwab, because they have an inherent price structural advantage, because Vanguard can use their own funds, as can Schwab. So Vanguard charges 0.3%. They give you a financial advisor. They invest in their own funds. They've raised $40 billion. Schwab gives it to you for free, invest in their own funds. They have a few quirks. None of them charge commissions, which is huge for small investors. Commissions can add up quicker than the fees do. Schwab has raised $9 billion. I think Betterment in third place just crossed $5 billion. I think they're all wonderful offerings. I think they're great ways to do it. The challenge is that a bit philosophical in the allocation. I think it's going to be a real struggle for people if and when they go through the next bear market to not have an advisor to talk to, because all the research shows that people behave very poorly when they're losing a lot of money, and there's no one to talk them off a cliff when they're down 10, 20, 50%.
Yeah, it'll be interesting to see how Betterment and Wealthfront display those losses in the user experience, right?
If you look on social media right now, you see a lot of people just behaving like uneducated investors. They're complaining that I invested and my account's down 5% in the first month. What's the point of this? So that you see a lot of this just people venting online. And hell, we're in a bull market. So I think it'll be a fun challenge for them. Now, the flip side is it a good business model? And that's going to remain to be seen, because they're going to have to scale to be very large to be profitable, because they have such low expenses on the portfolio. So, and then philosophically, as I mentioned earlier, my ideal portfolio is not buy and hold. I mean, we offer an ETF that charges no management fee, and so there's ways to get a low-cost portfolio that, look, you go back 20 years, I mean, hell, funds charge 2%, there's front-end loads, there's brokerage costs, and all sorts of stuff. So it's a great time with many options. The question is, can people overcome their emotions to make the low cost valuable?
Yeah, I got it. One other question is from Nico. He says, if you have $50,000 and you want to protect the principal and keep it liquid, but want more interest than a bank savings rate, is the standard route to go just to put it in T-bills or, T-bills basically?
Well, so a diversified allocation is a good step. So if you were to go buy a diversified fund with the knowledge that it could be volatile, but low volatility and could have drawdowns, I mean, that's not an unreasonable thing to do. For younger investors that don't have a lot of money, I honestly think personal finance is much more important than investing. So not paying 20% credit card bills, saving money, and doing a lot of things and not sweating as much their investment accounts, in the early days, but starting to allocate and allocate every month if you can help it, or every year, or how much ever you can contribute. That's what really snowballs over time, because the earlier you start and the more you start, the better it is. It doesn't matter so much the returns; those will come, but it matters that you're at least getting started. And so, look, if you can't risk anything, then of course the simplest way to reduce risk is not taking it in the first place. So you go buy a CD, or go buy, something that has guaranteed principal return from a bank. You may be only getting 1% or 2%, but that's, at least it's not. Historically, T-bills and short-term bonds keep up with inflation, and that's the best you're going to do. So after inflation, this is a good rule of thumb. We call it 5-2-1 rule. Stocks after inflation return about 5% globally since 1900. Bonds, and I'm rounding up, it's about 1.5%, but we say 2 just to round up because it's easier to remember. And short-term bills or cash instruments around 1%. In this environment, the 2 and 1 is probably going to be less, so it may be 4-1-0. But if you have 50,000 and you don't want to risk it, you shouldn't risk it. So.
Right. Well, if you just put it in like tips or something, say you had it for the money for a year and you didn't want to risk it, like tips would essentially be risk-free unless we went through short-term deflation. Is that right?
Yeah, but tips, like any bond, they're going to trade, or a bond fund, the price can move around. And if you look at like a 10-year bond fund going back to 1900, they were equally as risky as stocks once you included inflation. So a 10-year bond fund would have declined by almost 50% at one point because of the erosion of inflation. So they don't look as bad on the surface. Stocks, historically, the big risk is big price declines. Big bear market, lose 50-80%. Bonds, it may not look like they're losing much, but it'll happen over a decade because inflation will be eating away at the actual bond. So something like cash, same thing. If you are in a world of what people call financial repression, where inflation is equal or higher than the bond yields, then you're going to actually be losing money and just kind of, slowly not treading water, but essentially drowning from this chipping away of your principal.
Gotcha.
So bonds can be risky. It's just it's a little different.
Good stuff. Okay, one last question for you. It's my favorite question from Johnny. He says, if World War III breaks out, where do you want to be invested?
World War III. Well, it depends if it's
China or Russia.
It depends if it's a nuclear war or a war with aliens or whatnot. But historically, wars can be great times for investing, and wars are often, at least historically, and it's a different world we live in now because wars don't necessarily require as much economic capital as they did in the 30s and 40s, but wars historically have been very inflationary. And so during inflationary times, you look at assets that benefit from inflationary exposure is different than times of peace that may not benefit from similar exposures. Again, the challenge with asset allocation is you want to be prepared for any market environment. You want to be prepared. So the example we said with U.S. stocks and valuation earlier, trading at a CAPE ratio of 25. They've traded at a value of 45 and a value of 5. The only difference is simply what people are willing to pay. And so you have to hold in your head the possibility, and it's not equally likely, but the possibility that it can happen, that stocks could double from here or go down 80%, because both of them have happened in the past.
Yeah.
So coming up with an allocation where you say, look, I understand that this is what could happen to this allocation, this is what the world could look like, but let me have an exposure to everything so I can prepare not just for the tail risk of things doing very poorly to the downside, but also missing out on the upside. So you want exposure to surprises and shocks to the upside as well, with growth and bull markets too. So, same thing, have a diversified portfolio and don't bet the ranch on any one market outcome.
Yeah, a lot of these portfolios that you modeled all have a percentage in gold or commodities. I found that kind of hard to play within Vanguard because they don't have a gold fund, and they also don't, I guess they have a materials fund, which I guess would be kind of like the commodities, but I found it hard to get the gold component in. So I went in, I started a different account through E-Trade just to buy like GLD, which is a gold fund. But
yeah, so again, looking historically, every asset class, there's times when they do awesome and there's times they do horrific. And almost any asset class alone can have periods where they decline 50 to 80%. It's happened with REITs, commodities, gold, stocks, foreign stocks, everything. And so there's periods where gold just crushes it. I mean, the 2000s was a great period for gold. It's been terrible the last few years, but it's been great again this year. And so, and then the periods, they rhyme. There's things that are good for gold, such as negative interest rates and negative real interest rates. Great for gold, but it's not guaranteed. So owning some, I think, is a great hedge against a number of things. But again, I tend to be asset class agnostic. Most people that love gold are slightly insane. The gold bugs you talk to, they think the government's out to get you, and they're gonna buy a ranch with guns and stock up food for the next 50 years. I'm not saying that's totally crazy, but everyone tends to have their favorite asset class, and becoming wedded to those is really, really dangerous, because you can start to believe, kind of your own BS and own way too much. And then next thing you know, you have a 70% bear market and don't know what to do.
Yeah. Well, Meb, this has been a lot of fun. We could sit here and talk to you for hours and hours. So hopefully down the road we can have a round 2 and catch up more on what you're doing and see what the updates are. For all the listeners out there, Meb's got a lot of books. He's got a lot of content. Everything is very easy to get through and very educational. Also has a new podcast, so we'll leave those notes for everybody else. Meb, if there's anything else that the readers and listeners should pay attention to, any links that you want to share, please just forward them over. We'll include them in the show notes. And it's been a lot of fun. Just want to thank you for coming on the show and sharing all of your knowledge with us. We have a lot to digest.
Thanks for having me. Looking forward to next time.
Alrighty. So everyone else out there, look forward to another episode of Invest Like a Boss next week, and we will catch you soon. Okay. Thanks again, Meb.
Wow, that was another great episode. I really learned so much from Meb. And I really like how he broke down and made it so freaking simple on how to invest. I can't believe, I wonder how many of you guys got that trivia question right in the beginning.
I know I didn't. And unfortunately, even with that advice, over the last few days, I have just been deep into my Vanguard and E-Trade accounts trying to rebalance. So it's kind of like what he talks about. It's human nature. You want to overcomplicate things, and it's just way too easy to make adjustments now. So I'm trying to take his advice and just go away for the summer, but we'll see what happens when I get bored over the next couple of days.
Well, I think it's okay for us to, take a little bit of money and play with, new investment vehicles. Like, taking a look manually at PeerStream, like, okay, let's put some, a couple $1,000s in that, or let's put a couple $1,000s here or there. But I do agree that I think our main investment portfolios, our index funds, we should just leave it, just set it and forget it.
Let's do it. We need, it's almost like a support group. We need to be able to enact that.
Yeah, but it is exciting. I love seeing money come out. I love seeing new investment opportunities, which is why I think the majority of my money is in index funds, and the rest of it, I'm like, okay, let me play with it. He mentioned an app called Robinhood, which I've heard about before. It's a iPhone or Android only platform where you can trade stocks completely for free. But the reason why I have uninstalled it now is I realize I do not need to be buying individual stocks, and we don't recommend anyone doing that either.
Yeah, that's very good advice. And I have my E-Trade account where I'm still picking stocks, but it's a pretty small percentage of my overall portfolio and definitely of my overall investments. So it's more just for fun. Like I bought Facebook stock, Tesla stock, just because I like the companies. I like to think that I can see the future. So those are my badges.
And I think that one of the worst things to do would be for us to lay in bed on our phones, just like, oh, let's buy some of this stock.
Yeah, it's too easy. Got to get away from it all. It's better just to own paper and get away from your computer screens.
I like it. So speaking of paper, thank you guys for taking the time to write out these great reviews on the Invest Like a Boss podcasts. I know it's not real paper, it's e-paper, so it's even easier for you to go online, just type it out. It helps us spread the word of this podcast so much. It's been growing. Thank you guys all for telling your friends about it as well and sharing it. This podcast really has just blown up.
Yeah, it's been a lot of fun too. As much as I hope everyone else is learning from it, Johnny and I are certainly learning a lot ourselves and taking the knowledge and applying it to our own investment strategies.
Nice. So who do we have this week that has left podcast reviews?
Well, we have a lot. I'll read off one from Holly from the UK. Thank you, Holly. 5-star review. I listen to a lot of business-related podcasts, and this is honestly one of the better ones. They present detailed investing advice in a casual and easy-to-digest way. I love their variety of guests, and I always look forward to the next episode. Keep up the good work, guys.
So thank you. And I'm going to read just two of them. JL 2010. I'm really enjoying this podcast because it contains so many interesting subjects related to finance and investing. I know there are tons of other similar podcasts, but Johnny and Sam are providing their unique perspective and real life examples. These guys walk the talk. And since it is now a new month, we want to give away another $25 Amazon gift card to one person who has left a review and sent in a screenshot. So this month is going to be Anastasia V. She says, awesome podcast. I've been following Johnny's journey since the beginning and built my own passive income thanks to him. Super stoked to hear that what he and his cohorts have to say about investing. These two are always on point with honest, smart, and actionable advice. Keep it up, guys. Thumbs up.
That's great. And you know what? We should ask Anastasia how she built her passive income. That'd be a nice to hear, and certainly a testament to your prowess, Johnny FD.
Yeah, actually, this is the whole kind of point, is for everyone to kind of follow along the journey, either save up money through your existing job or build your own passive income streams as an entrepreneur, so you can travel like a boss, then you can invest like a boss. So Anastasia, congratulations, not only on winning the $25 gift card, but also on building your passive income up to a point where now you're investing, and then now you're going to be making money with your investment income as well.
Yeah, congratulations. And thanks everyone else for the reviews. They really help us get additional guests onto the podcast. It definitely helps with our own satisfaction of what we're presenting out there to everybody.
Awesome. See you guys all next week. Thanks for listening to the Invest Like a Boss podcast. Join our mailing list at investlikeaboss.com to get exclusive access to our insider investment portfolios and our private members forum.
If you enjoyed this episode, please subscribe on iTunes or your favorite podcast app. Tell your friends and leave us a review in the iTunes store. It helps more than you know. See you guys next week.